Welcome to Value Investing University. My name is Mariusz Konieczny, and in this video I will be talking to you about the income statement. So without any further delay, let's go ahead and get started. What is the income statement? Well, the income statement is one of the financial statements the business owners or their accountants prepare to communicate to others an enterprise's success in terms of profitability. Unlike the balance sheet, the income statement is prepared for a given period of time, such as a quarter or a year, versus a snapshot on a particular day. The preparation of the income statement is based on the following formula. Revenues minus costs and expenses equal either profit or loss. If the company brings in more money than it pays out in expenses, then the company generates a profit. If the opposite is true, then the company generates a loss. And it is not unusual for businesses, even the best ones, to sometimes generate losses. But they must be temporary. Eventually, they have to get back to profitability because losses can only last for so long. Eventually, losses deplete capital until there's nothing left to pay for wages or buy raw materials to produce inventory. Let's take a look at how the income statement is structured.
The income statement of any company usually has 4 sections: revenues, costs, operating expenses, and other income and expenses, which result in net income or net loss. Revenues show how much money the company generated by selling its products or services. Costs, which are not the same as expenses, represent what it costs the company to acquire or develop what it is that it is selling. Later on in the video, I will discuss in more detail the difference between costs and expenses. Operating expenses represent spending on activities required to operate the business. Other income and expenses represent income and expenses that are not considered to be operating expenses. After all of the costs and expenses are subtracted from revenues, net profit or net earnings are reported on the income statement. Then those net earnings are recalculated into earnings per share.
If I asked you why businesses fail, what would you tell me? If you were like most people, you would probably say something like bad customer service, inferior product, poor marketing strategy, or maybe bad management. And while these answers can most definitely contribute to the failure of businesses, the biggest reason why businesses fail is because they lack revenues or adequate revenues. As you have seen in the previous section, revenues are reported first on the income statement. And it is because revenues are the ultimate top line. They are the lifeblood of any business. If you don't have revenues, then nothing matters. You can cut your expenses to the bone, but it won't matter. Because if you don't have any revenues, any expenses above zero will make your business unprofitable. And as I mentioned before, unprofitable businesses can only stay open for so long. When reading the income statement of any company, you really have to understand where the revenues are coming from and what is behind them, driving them. Because otherwise, how in the world are you going to forecast what the revenues are going to be in the future? And remember, it's the future that counts, not the past. Ask yourself the following questions. Where are these revenues coming from? Why are customers buying from this company? Is it because their products are the best or the cheapest? How hard would it be for the customers to simply switch to a competing product or service? Why did the revenues increase or decrease during the last 3, 5, or 10 years? Are they likely to increase or decrease in the future, and why? Let me show you some examples of how this process can be applied.
This is the income statement for Bridgepoint Education, which is an online university similar to the University of Phoenix. As you can see, revenues grew fantastically from 2009 to 2011. They more than doubled. If you did not go through the kind of process that I'm describing in this video, you could make the assumption that revenues will continue to grow. But this might be totally wrong. What this income statement is telling you is that revenues grew from 2009 to 2011. And notice that I emphasized the word grew, which means the past. And the past is not the future, and it is the future that counts. Just because there was growth in the past does not mean that there will for certain be growth in the future. This means that you have to take your time to understand the revenues in order to truly know what kind of company that you're dealing with. Let's look at some of the questions that you should be asking yourself. Where are the revenues coming from? Well, Bridgepoint Education is a company that has 2 universities. So the revenues come from tuition paid by students who are pursuing bachelor's and master's degrees in various different fields. Next question. Why are customers choosing to attend the company's universities? Well, this is because Bridgepoint Education's universities are very affordable and flexible to student schedules. The majority of students never even set their foot in the physical building, as they take all of their classes online. Why did revenues increase during the last 3 years? Well, revenues increased because the company successfully marketed its educational services to demographics that have been completely ignored by traditional colleges and universities. You see, if you're an adult looking to get a college degree, enrolling in traditional colleges and universities is a hassle. These institutions do not accommodate your schedule very well because they mostly cater to high school graduates who don't have any responsibilities and are able to dedicate themselves to pursuing degrees full-time. Because of these dynamics, companies such as Bridgepoint Education or University of Phoenix benefited by satisfying an unmet need to educate adults who have different needs. Next question. Are the revenues likely to continue increasing in the future? To answer this question, it is not enough to simply assume that past increases in revenues are going to mean future increases in revenues. You have to understand the business and what is going on in the industry. In the example of Bridgepoint Education, I believe that it is highly unlikely that the company will continue to grow as fast as it did in the past, and there are a few reasons for it. First is that traditional colleges and universities are starting to wake up to the fact that online schools are eating their lunch and are slowly developing their own online programs. Second, Bridgepoint Education is facing serious short-term problems with accreditation, which could cause the entire business to shut down. You see, if a school loses its accreditation, this means that students cannot use their government loans to pay for their tuition. And as you probably imagine, most of the students rely on these loans, and no school can survive without proper accreditation. Students don't have the money to pay for tuition themselves. Now, just because the revenues of Bridgepoint Education will probably not grow as quickly as they did in the future doesn't mean you should invest in the stock of the company. It all depends on the price that you pay for it. if you look at the stock price of Bridgepoint Education, it is trading at about $10 per share, which means that the company is trading for a P ratio of less than 4. But this is obviously based on the earnings of the past, which might not be repeated again. However, if the company is able to resolve its accreditation issues and continue providing its educational services to students, the stock would probably double, triple, or even quadruple from here. So now the focus shifts on whether the company will be able to resolve the accreditation issues, and this is obviously up to you to determine whether this will happen or not and what the probability of this happening is. Let's go back to the income statement. Another thing that I want to point out about revenues is that it is not a good idea to assume where the revenues are coming from. And here's what I mean. If I asked you where the revenues of eBay were coming from, what would you say? Well, probably something like eBay is making its money through online auctions. Okay, how about this? Do you think eBay is growing revenues? If you're like most people, you would probably say, well, online auctions have been around for quite some time, so eBay is making good money, but they're probably not growing aggressively anymore. Well, I would probably say that you are making incorrect assumptions. And the reason for this is because you are assuming that eBay is only making money through online auctions, because this is what eBay is known for. While it is true that eBay makes its money through online auctions, eBay also owns PayPal, which is a global e-commerce business allowing payments and money transfers to be made through the internet. And PayPal is the biggest growth engine for eBay. Look, PayPal is great. It's a fabulous way for small businesses to sell things on their websites without the need for credit card processing. Look, I even use eBay on my website. This is where I sell my stock picking newsletter. And if you go to the bottom, you can see that I use PayPal as a method of payment, and I love it because people can use PayPal even if they don't have a PayPal account. They can just use their credit card, but I don't have to worry about whether their credit card works or what to do when it expires. eBay takes care of all of this. But if you looked at the income statement of eBay, as you see on your screen, you would know that it owns PayPal. All you see here is net revenues on the top line, and this doesn't tell you much. It doesn't tell you where the revenues are coming from or how much is coming from various sources. And to find out more in detail where the revenues are coming from, you obviously have to read the entire 10K. And one final thought that I wanted to say about revenues is that they are not created equal. Some revenues are more desirable than others. For example, if you had a choice between generating revenues by teaching scuba diving or providing cell phone services like Verizon, which one would you choose? Well, I would choose revenues from cell phone services like Verizon because, believe me, people don't forget to pay their cell phone bills. Cell phones are very important to people, and how many times do you hear stories of people feeling like they left a part of their body behind when they forget to take their cell phones with them? Consequently, this kind of revenue is very stable and predictable. Teaching scuba diving, on the other hand, is completely the opposite. People don't need it, and when something unexpected happens to them, this is the kind of thing that they cut first. Consequently, this kind of revenue stream is not as durable and dependable as Verizon's revenue. But notice one thing. Am I saying that you should only be investing in companies with high quality revenue streams? No, of course not. I'm not saying that. You can make money in all kinds of companies. It's all about price and what you get for the price. Sometimes you can buy stocks of companies for such low prices that the quality of revenues doesn't even matter that much. But I want you to know what you are buying. High quality companies with high revenue streams are usually more expensive, and this is justified. But if you don't pay attention to what you're buying, you might end up buying a company with a low quality revenue stream at a high quality price, and you don't even know it. So take the time to understand where the revenues are coming from, what is driving them, and whether they are stable. And don't assume where the revenues are coming from just because you recognize the name of the company, like eBay. The companies are nothing but legal entities, and they can hold as many businesses as they want to, and the name itself does not tell you all the revenue generating avenues of the holding company.
In the previous section, I put a lot of emphasis on understanding revenues and where they come from. There's no question that revenues are the most important thing because without them, nothing really matters. However, revenues on their own are not enough. A business must be able to operate in a way that allows revenues to exceed costs and expenses. And before discussing various costs and expense items, I want to differentiate between two terms: costs versus expenses. And many people use them interchangeably, but in accounting, they're not the same thing. Cost is the price of an asset. For example, equipment is an asset, and the price you pay for it is its cost. Inventory is also an asset, and the cost of acquiring inventory or producing inventory yourself is a cost. When producing your own inventory, the cost includes raw materials, direct labor, and manufacturing overhead. Expenses, on the other hand, are not associated with assets, but they are required in the production of revenues. For example, you need marketing and selling expenses to generate revenues. You need rent expenses to sell your products or services and thus generate revenues. So costs are required to produce assets, and expenses are required to produce revenues. With that being said, costs may or may not become expenses. In other words, they may or may not show up on the income statement because only expenses show up on the income statement, even though they might be called costs on the income statement. For example, when you acquire inventory, at the time of the acquisition, the cost is not yet an expense. Inventory only becomes an expense when it is sold. Then the cost of this inventory is being expensed on the income statement through a line item called cost of goods sold, which I will be discussing shortly. Also, the cost of equipment can become an expense and be shown on the income statement through depreciation expense, which I will also discuss later. An example of a cost that never becomes an expense is land, because land is never depreciated and therefore never shows up on the income statement. Let's take a look at some expense items.
This is the income statement for Arctic-Cat, which manufactures snowmobiles and ATVs. As you can see right below sales, the income statement lists the cost of goods sold. What this represents is the cost of manufacturing the products that the company sells. In this example, it is snowmobiles and ATVs that the company sold. It is very important to distinguish between products that have been sold and products that have not been sold. If the product has not been sold, it will not show up on the income statement because it has not generated any revenues yet. And because no revenues have been generated, there are no costs to be matched against revenues. Only the products that have been sold show up on the income statement under the cost of goods sold. And here's how this process works. You produce a product, and this requires you to buy raw materials and hire people to convert these raw materials into finished products. This cost goes into inventory, which shows up right here on the balance sheet. Then, when you sell the inventory that you just produced, you record revenues. But then, on the income statement, you have to show how much it costs you to produce whatever it is that you just sold. This is what the cost of goods sold is all about. In other words, what you just did was you took an asset, which is inventory, and you expensed it through the income statement through an item called cost of goods sold. The amount that you recorded as the costs of goods sold is the same amount which you reduced your inventory by. In other words, you took your items from the inventory on the balance sheet and you expense them through the cost of goods sold on the income statement. I know this is confusing, but you really need to understand it. Also notice that Arctic-Cat sells parts, garments, and accessories. These include a bunch of stuff like jackets, helmets, snowmobile parts, and informational videos. Of course, these things also cost money to produce, and because they are sold separately, the company decided to report a separate cost of goods sold category for these items. When you look at various income statements, the cost of goods sold may be shown under a different name. For example, this is the income statement for Mitcham Industries, which leases seismic equipment to the oil and gas industry. The income statement shows the cost of sales instead of the cost of goods sold, but this is really the same thing. With service companies, on the other hand, which do not manufacture any products, the cost of goods sold is shown as the cost of revenue, which is the cost of delivering a particular service. For example, this is the income statement for eBay, and because eBay does not manufacture anything, we don't see the cost of goods sold on eBay's income statement, but what we do see is the cost of net revenues. And let's go back to Arctic-Cat. So after the cost of goods sold or costs of revenues are subtracted from revenues, gross profit is shown on the income statement, and gross profit measures how effectively the company manufactures its products or delivers its services. Operating expenses have nothing to do with manufacturing products or delivering services. They are required to generate revenues. Think about it for a second. Let's say you are in the business of manufacturing and selling soccer balls. Just because you manufacture these soccer balls doesn't mean that you're going to sell them. Now that you produce them, you have to do certain things to sell them, which include opening a retail shop, advertising in magazines or on the internet, or hiring salespeople to sell them. These kinds of expenses are called operating expenses, and they are listed after gross profit on the income statement. The most common operating expenses are selling and marketing expenses, general and administrative expenses, research and development expenses, and depreciation expenses. Let's talk about each of them. Usually the first item under operating expenses is sales and marketing. Sometimes sales and marketing are combined with general and administrative expenses as SG&A, which stands for selling, general, and administrative expenses. With Arctic-Cat, these two expense categories are listed separately. Selling and marketing expenses include everything a company has to do to acquire new customers or keep existing customers. Many people think of selling and marketing as only advertising and sales, but this is not completely accurate, because advertising and sales, yes, they are part of selling and marketing, but there's a lot more to it than just advertising and sales. For example, selling and marketing expenses also include preparing the merchandise for sale, which would be considered things like shipping and handling expenses and warehousing. The key to analyzing selling and marketing expenses is to study how effectively the management is in converting sales and marketing dollars into revenues. Because remember, the purpose of operating expenses is to generate revenues. And just throwing a lot of money into sales and marketing is not going to magically generate results. These sales and marketing dollars have to be spent wisely to generate adequate returns. I talk more in detail about how to measure the effectiveness of selling and marketing in my video on financial ratios. General and administrative expenses. General and administrative expenses include the expenses required for day-to-day operations of running a business. Examples include rent, office supplies, accounting and legal fees, utilities, insurance, and managerial salaries. You should pay very close attention to general and administrative expenses because they can be very useful to you. Let me give you an example. Again, this is the income statement for Mitcham Industries, which, as I said before, leases seismic equipment to help oil and gas companies locate where to drill to find new oil and gas reserves. If you look at the last 3 years of general and administrative expenses, you will notice that they increased from 14.9 million to 21.3 million. This represents an increase of 43%, which could be seen as a lot, but this number alone doesn't tell you much. When you look at revenues, we see that during the same period they increased from 55.1 million to 112.8 million. This is more than 100% increase. So you have a situation where general and administrative expenses increased 43%, while revenues increased more than 100%. Why? Well, if you talk to the management of this company or listen to the company's conference calls, you would have learned that the company benefits from operational leverage, which means that when revenues increase, general and administrative expenses do not increase as much. And obviously this benefits the bottom line tremendously when revenues increase. I mean, just look at the net income. It went from $520,000 to $24.3 million during the same period. This is an increase of almost 5,000%, while revenues only increased by 100%. So this is the power of operating leverage. And here's the reason why Mitcham Industries benefits from operating leverage. You see, when a company leases out seismic equipment to its clients, it does not provide them with drilling personnel. It only leases the equipment, and clients themselves need to find people to operate this equipment. What this means is that when Mitcham Industries expands and acquires new equipment for leasing, they don't have to increase general and administrative expenses that much, but revenues associated with the newly purchased equipment increase. And by carefully analyzing general and administrative expenses and calculating how their growth compares to the growth in sales, you can get clues about whether a particular company benefits from operating leverage. With that being said, general and administrative expenses can also be a place where managers waste shareholders' money on unnecessary things that do not necessarily help in any way to generate more revenues. Let me give you an example. Okay, this is the income statement for Ambassadors Group, which is in the business of hosting international trips for students living in the United States. As you can see, from 2005 to 2007, revenues increased from 69.2 million to 114.5 million, which represents an increase of 65%. General and administrative expenses increased from 8.2 million to 15.2 million, which is 86%. In other words, general and administrative expenses increased faster than revenues, 86% versus 65%. This doesn't scream abuse yet, because revenues did increase nicely, but when you dig a little deeper, you learn that the management chose to build a brand new headquarters for the company, even though it was completely unnecessary. The property that they were leasing before was completely adequate, but apparently the management's ego got in the way. As you can see from this income statement, the company had several very good years, so they decided to build a brand new headquarters. This obviously increased general and administrative expenses, but this additional spending did not in any way contribute to generating higher revenues. You see, the revenues after they got the headquarters, they actually decreased, and all it did when they got the new headquarters is it increased the company's fixed expenses, which are very difficult to cut when revenues slide. And this is exactly what happened after 2007. Revenues collapsed because of the slowdown in the economy, and the company was stuck with a huge headquarters building, which was costing the company a fortune to maintain. And this is the stock price of it got crushed. At the beginning of 2008, it was at $20 at one point, and then it collapsed, but it collapsed with everything. But even today, the stock price is even below $5. So from 20 to 5 over such a long period of time. And I'm not saying that the stock wouldn't have declined if the company never built a brand new headquarters, but it probably would have declined less. Only now the management is learning their lesson, because they are now trying to sell the headquarters to cut expenses, and the property is now listed on the market. But the problem is that they can only get maybe half of what it cost them to build it, and what a waste of shareholders' capital. So to summarize, let me go back to the Arcticat. So to summarize what I said about general and administrative expenses, pay attention to how they grow in relation to the growth in sales. This might help you determine if the management is good stewards of shareholders' money, and it might also help you discover if the company benefits from any operational leverage, like I showed you on the income statement of Mitcham Industries. And anytime you hear about general and administrative expenses increasing, ask yourself this question: will this increase help the company generate more revenues? If not, why are general and administrative expenses being increased? Research and development. Research and development expenses involve spending money to create new products and improve existing products. Arcticat's research and development expenses consist of activities required to develop new snowmobile and ATV models and improve existing models. Especially for companies that are involved in selling products, spending on research and development is extremely important. For example, can you imagine what would happen if Apple stopped spending money on research and development? well, competitors would catch up and the current products that Apple sells would become obsolete, and eventually the entire company would go out of existence. While spending on research and development is important for most companies, some don't have to spend a dime on it. For example, this is the income statement for International Speedway Corporation, which is in the business of hosting NASCAR racing events. There is no research and development expense listed in the company's income statement, and the reason for this is because the company does not sell anything. It only owns racetracks and hosts NASCAR racing events. Research and development is not required. Depreciation. The depreciation expense is the gradual expenditure of fixed assets from the balance sheet to the income statement. This is the income statement for Arcticad, and as you can see, we do not see the depreciation expense on this income statement, and I will explain why shortly. Let me first talk about depreciation. You see, when you purchase an asset such as a building or a piece of equipment, you report it on the balance sheet at cost. However, you do not immediately expense it through the income statement. Instead, what you do is you only take a fraction of the cost, and this is the amount that you expense as the depreciation expense on the income statement. For example, if a piece of equipment costs you, let's say, $100,000 and it will last for 10 years, you will only expense $10,000 each year until you fully depreciate it. In other words, you allocate only a portion of the asset's costs to individual years. As I previously said, we do not see any depreciation expense on the income statement for Arcticad. But this doesn't mean that there is no depreciation expense. You see, when you go to the company's cash flow statement, you see that in 2012 there was 13 million of depreciation and amortization expense. This amount is part of costs and expenses on the income statement, even though you can't see it on the income statement when you look at it. And some companies choose to show you the depreciation on the income statement and others do not. For example, this is the income statement for Mitcham Industries, and as you can see, there is depreciation listed. But notice one thing: depreciation is listed twice. First, it is listed under the cost of sales, which is the same thing as the cost of goods sold. Then it is listed again under operating expenses. Why is it listed twice? What's going on here? I thought that depreciation was only an operating expense. Well, whether the depreciation expense is reported as part of the cost of goods sold or part of operating expenses depends on the asset being depreciated. If the asset being depreciated is used for the manufacturing of your products, then yes, depreciation expense is included in the cost of goods sold. But if the asset is being depreciated and it is used for selling and marketing activities or maybe research and development activities, then depreciation is part of operating expenses. And just because depreciation is not singled out on the income statement doesn't mean that it's not there. If we go back to the income statement of Arcticad, I don't even need to read the entire report to know that there is depreciation and it is included in the cost of goods sold. And the reason I know this is because when I go to the balance sheet, the company lists machinery, equipment, tooling, building, and improvements. Some of these assets are used for the manufacturing of snowmobiles and ATVs. Also, I see there is a line for accumulated depreciation. And if you watch my video on the balance sheet, whenever you see accumulated depreciation, you know that there is a depreciation expense going through the income statement. Because the companies may or may not show you depreciation on the income statement, the best place to determine whether there is depreciation and how much depreciation there is to look at the cash flow statement. And usually the first item listed after net income on the cash flow statement is depreciation expense. It's depreciation expense that is included on the income statement, but may or may not be shown on the income statement. The four main operating expense categories are selling and marketing expenses, general and administrative expenses, research and development expenses, and the depreciation expense. With that being said, you will occasionally see other operating expenses, and let me show you some examples. On the income statement for Mitcham Industries, we see provision for doubtful accounts. On the income statement for Flow International Corporation, we see some kind of restructuring charges. On the income statement of the Dolan Company, you see impairment of long-lived assets. Let's discuss some of these items. Let's go back to Mitcham Industries. You see provision for doubtful accounts. This expense item can be singled out like it is for Mitcham Industries, or it can be part of selling and administrative expenses. If it is not singled out like it is here, then it is still there, and to find it you have to go to the cash flow statement. Let me give you an example. This is the income statement for Flow International Corporation, and we do not see any provision for doubtful accounts. But when we scroll down to the cash flow statement, we find it here, but under a different name, bad debt expense, which is the same thing. This means that this expense was part of operating expenses on the income statement, but it was simply not shown. Okay, let me tell you what provision for doubtful accounts is. And let's go back to the Mitcham Industries. You see, usually when businesses sell their products and services, they extend credit to their customers. But sometimes, for whatever reason, the customers don't pay or can't pay. So businesses have to estimate, based on their history, how much of accounts receivable will not be collected, and expense it on the income statement through a line item called provision for doubtful accounts. Okay, let's take a look at another expense item. And to do that, we will go to the income statement of Flow International Corporation. On this income statement, we see some kind of restructuring charges. And these are one-time costs that the company incurs when it restructures. Some examples might include charges such as laying off employees, closing manufacturing plants, or shifting production to different locations. And the purpose of restructuring charges is to save the company money in the long term. Because they are one-time expenses, many times what investors do is they often take these expenses out when calculating company's profitability and or when they're trying to use net income to value companies. Okay, let's move on to another item that you might find on the income statement, and to do that, let's use the income statement for the Dolan Company, and the item is impairment of long-lived assets. Remember when we talked about how fixed assets are depreciated over a number of years because of their long usefulness? Well, sometimes the usefulness is cut short due to damage or unusability or maybe obsolescence. When this happens, a portion or the entire amount of what is not yet depreciated on the balance sheet might have to be written down. And this is considered impairment of long-lived assets. It's a write-down on the asset. It's the write-down of the asset on the income statement. But it is not. It is a non-cash expense because the money to buy the asset was already spent a long time ago. And because of this, a lot of investors realize this, and when they look at try to determine the company's profitability or value it, they might take it out of the income statement to get a better picture of what the profitability would be if the impairment was not included as part of the operating expenses. After operating expenses are subtracted from gross profit, net income lists operating profit. And another name for operating profit is EBIT, which stands for earnings before interest and taxes. And this is because interest expense and taxes are both listed after it. It is important to understand that operating profit is a profitability measure only for the portion of the business relating to the operations. It does not include any money generated through interest. Any interest earned by the company by either keeping cash in the bank or in short-term securities is listed below the operating profit in the other income and expense section. Also, operating profit is a profitability measure as if the company did not have any debt and thus did not have to pay any interest on borrowed money. Any interest expense on borrowed money is reported in the other income and expense section of the income statement. Operating profit is used often to calculate what is called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Because operating income is already EBIT, all we need is DA in EBITDA. And where we get it from is the cash flow statement. So let's calculate it here. Take out the calculator and look for first for EBIT, which is the operating profit. So we type in 4590, and then we go to the cash flow statement to find depreciation and amortization, and we find it, and it's 13 million. So we add 13. Okay, and what we get is 58.9 million. And EBITDA is used by investors to calculate the profitability of the operating business after excluding depreciation and amortization, which are both non-cash expenses. Okay, let's go back to the income statement. And after the other income and expenses are subtracted from operating profit, the income statement lists income before taxes, which is exactly what the name suggests, one step before income taxes. Then after income taxes are subtracted, the income statement shows net income or net earnings, which is the ultimate bottom line. This is the amount that the company earned after all of the expenses have been taken into account. The two figures below represent earnings per share, which is net income divided by the number of shares outstanding. In this example, we have two figures showing the number of shares outstanding. We have basic and diluted shares outstanding. I always pay attention to the diluted shares outstanding, which is a more conservative measure. Basic shares outstanding represents the number of shares outstanding, but diluted shares outstanding also includes shares that could come into existence when all convertible securities are converted into common stock. Examples of convertible securities are stock options, warrants, and convertible preferred shares. And depending on whether basic or diluted shares outstanding are used in relation to net earnings, we get earnings per share either basic or diluted. And I like to look at both, but really I pay more attention to the diluted one because I always like to stay on the conservative side.
In the video Understanding the Balance Sheet, I talked about how assets can either be financed by liabilities or shareholders' equity. In other words, assets can be funded by creditors or shareholders. There are only two ways that shareholders can fund the acquisition or development of assets. They can give the company money by purchasing shares that are being issued, or they can let the company retain the profits that belong to shareholders. You see, the profits that are shown on the bottom of the income statement tell you how much money the company earned after all the expenses are taken into account. But the income statement doesn't tell you whether these profits were retained by the company or whether they were paid out to shareholders in the form of dividends. Let me show you what I mean by this.
This is again the income statement for Mitcham Industries. As you can see, in 2012, the company's net income was $24.3 million. And there are only two things that can happen to these profits. They can either be retained within the company, or they can be paid out to shareholders, or partially paid out, or partially retained, however you want to put it. If they are retained within the company, they can be used to grow the company. If they are retained, they show up on the balance sheet under retained earnings. So remember this number, 24.3 million of net income. And let me show you. If we go to the balance sheet, on the bottom, you see two numbers, and they represent retained earnings. As you can see, retained earnings increased from 14.9 million in 2001 to 39.2 million in 2012. Let's calculate how much retained earnings increased. So to do that, we just take the difference between the two. So we'll take 39,297 minus 14,976, and the difference is 24.3 million, which is exactly the net income that we saw on the income statement. In other words, because all of the profits were retained by the company, the entire net income shows up on the balance sheet as the increase in retained earnings. And this obviously, because retained earnings were increased, this increases the entire shareholders' equity, because retained earnings are part of shareholders' equity. And it makes sense because earnings belong to shareholders, and if they are retained by the company, this is as if shareholders were adding more money to shareholders' equity. But you will not always get such a perfect calculation as you see here, and let me show you why. Okay, this is again the income statement for Arctic-Cat, and on the bottom you see that net income for 2012 was 29.9 million. And I know that Arctic-Cat does not pay any dividends, which means that all of these earnings were retained. So let's see if the retained earnings on the balance sheet increased by this amount. Okay, so this is the balance sheet. And as you can see, retained earnings did not increase. Actually, retained earnings decreased from 177.5 million to 127.8 million, even though net income or profits were retained by the company. Well, how is that possible? In order to find out why, we need to look at another statement which is not discussed in this video, and the statement is called Consolidated Statements of Shareholders' Equity and Comprehensive Income. And let me show you. It is this statement here. And by looking at this statement, we can see how retained earnings went from 177.5 million to 127.8 million. Because the company retained earnings, we can see how they were added to retained earnings. But there was another item that decreased retained earnings by a lot, by 79.6 million, which was the repurchase of Class B shares. And I'm not really sure why they're including the repurchase of shares as a decrease in retained earnings, but it doesn't matter for this video. So this statement looks very confusing and complicated, but it is not. And I'm not going to cover it in this video, but if you watch this video and my other 2 videos on financial statements, you should not have any problems figuring it out how to read this statement.
In this video, you learn how to read the company's income statement, which shows you how much a business generated in revenues, how much it paid out in expenses, and how much was left for shareholders in net profits. Notice that I used past tense, and this is because the income statement shows you what happened in the past and not what will happen in the future. And never forget, it's the future that matters. If you want to get the most out of investing, take the time to truly understand the company's revenues, meaning where they are coming from and what is driving them. Then invest some time understanding the expenses. Don't just look at them, but understand why they are what they are and why they are important to the company's operations. If you do that, you will increase your probability of picking profitable investment opportunities. So with that being said, thanks for watching, and I hope you enjoyed it.